So good morning, ladies and gentlemen, and welcome to this webinar in which we're going to be giving advance view of the LaingBuisson report, upcoming LaingBuisson report on care homes for older people. This is a major report for LaingBuisson. I also think it's a major report, particularly against the background of the stresses in the care home sector that we've experienced over the period of the pandemic. It's a significant source of new information about our social care economy. So welcome to this webinar. My name's Stephen Dorrell. I'm a director of LaingBuisson and have been working with William and the team, not just on this report, but on the development of LaingBuisson for some years now. Welcome to this webinar. I shall be introducing the various speakers in the webinar, and part of the purpose of the event is to provide an opportunity for a discussion under the Chatham House rule of the points that William is going to make when he speaks to get the discussion going. Before we come to William Laing, I'd like first to introduce our commercial partners in the development of this report. CMS, a global firm of lawyers, as I'm sure everyone is aware, more than 1,000 partners worldwide operating in 45 countries through 80 offices. So a very major legal firm working in this space. And we're very fortunate to have this morning Candice Blackwood, who's the co-chair of the life sciences and healthcare sector for CMS in the UK. She's also a partner on the real estate team for CMS. And has had a long experience working in this space on behalf of clients from private equity, from REITs and from pension funds. So Candice, you speak with great authority on these subjects, and you're very welcome at the beginning of this important webinar.
Thank you very much, Stephen, and morning everyone. Thank you for joining us today. It's been our pleasure over several years to partner with LaingBuisson on the annual Care Homes for Older People report and this launch event. And it's never been more important for the care industry than this year, as we emerge together from 2 years of a pandemic and look forward together alongside you, our clients and contacts, at changing regulatory requirements, different care needs, different expectations from residents and families and the health authorities who are paying for care, and especially as we look to the Health and Social Care Bill. It's a tough time, a challenging time, but a busy and exciting time. And there's no one better to discuss it than the group here this morning. I'm delighted to be handing over now to William Laing, who is the author of the report. William, over to you.
Thank you very much, Candice. And this is actually the 32nd edition of the Care Homes for Older People report. And mostly we're simply updating and commenting on a few new things that have happened, but very rarely is there a sort of watershed moment, which it feels to be right now with the social care reforms. But we'll talk about that in the main part of the presentation. So let me start by looking at first of all the adult social care funding gap. This is focusing on the public pay side. There have been an awful lot of estimates of what the funding gap is. The Health Committee put it in 2021 at £7 billion, but really the quantum depends on how it's counted. But the reality is that it is certainly there. And this is if you go into the next slide, I think this is the best illustration of where it comes from. And if you look at the spending by English local authorities on adult social care, and you see what happened in the sort of boom years of Labour before the global credit crisis, rising spending. And there we are, we see 2011, 2012, austerity, and the spending in nominal terms, and more importantly in real terms plummets, and then there's a partial recovery since. But you see that where we've got to now, we're only just at the point in real terms of where we were a decade ago before austerity. And actually that's flattering because the pound, we say real terms, but real terms is measured by CPI inflation. And in reality, the inflation of care costs has been much higher. So really, in real terms, we are actually below the level of spending that we had a decade ago. So that's the social care funding gap, which is the background to all this. Okay, next slide, please. Goodbye to COVID. Well, let's hope so. If you go on to the next slide, please. So what we found is, well, first of all, independent sector, I think everyone would agree, it's proved itself as a reliable infrastructure provider. It could have been a disaster. It could be the calls for renationalization of the care home sector. Extremely difficult, but the point is that the independent sector, all 6,000 or 7,000 operators within it, rose remarkably well to the challenge, and there aren't any questions really now about the place of the independent sector. It provides 95% of all care services. Now, we looked to see what statutory accounts told us about the impact of COVID. And the interesting thing is, I can remember right at the start, there was a panic about the massive potential costs from PPE, etc., etc. But when we actually look at the accounts in the cold light of history, we find that the financial costs of COVID, I'm not talking about the logistical, the effects on staff, which were very, very severe, but the financial costs were absorbed with very little fallout. Mitigated by government support, including the Infection Control Fund. The older people's care homes were impacted most out of all the social care providers because of reduced occupancy. But still, if you look at this, if you look at a chart of profitability and sales, it's to a certain degree, you can say that COVID will be lost in background noise. So that's quite interesting, I think, myself. And this comes from, as I say, reviewing the accounts of about 100 care providers. So question, will occupancy bounce back to pre-COVID levels by 2023? We are projecting they will do, but it will take that long. Another question is, has COVID shifted demand to substitutes, to live-in care, to extra care? And we'll come back to that later on. And the other thing which is very interesting to me is, why did COVID not trigger more capacity closures? So if we go on to the next slide. This is right up to the end of 2021. This is a chart showing opening and closures of care homes for older people. And you see the waves quite clearly, that when you get high rates of openings, you get low rates of closures, etc., etc. It's really quite a nice little chart. And the interesting thing to me is that if you look in the period 2021, there was no net dropout from the market, no increase in closures. And that to me is quite interesting itself about the ability of care homes to survive their resilience. So let's go on to the next slide, please. So from COVID to social care reforms, frying pan to the fire. So what do I mean by that? Let's go on to the next slide, if you could, please. So just to recap very, very briefly on what the policy objectives are. And I've divided this up into pre-reform and post-reform. So we know pre-reform citizens face catastrophic long-term care costs. Post-reform, we have the upper asset threshold and the lifetime care cost to give protection to citizens. Pre-reform, we now know, or the government now accepts that local authorities don't always pay full costs of full care home costs. They didn't before, but they have done so now. And the central government there is going to be a funding injection to enable local authorities to pay at fair cost rates. Question is, of course, what fair cost means. Pre-reform, we know that most operators are only viable through the contribution of premium private fees because of cross-subsidization. And post-reform, care homes should become able to operate viably on local authority fees only, as long as those fair cost rates are sensible. And then the last one, endemic cross-subsidization, we know that. And then this is the real killer, the harmonization or equalization of fees, whatever you call it, in 18.3, should enable private payers to access care at fair cost rates, depending on what those fair cost rates are. But the problem is, as we see it, is that the new central government funding earmarked for fair price is simply insufficient to realize the ambitious market reshaping that is envisaged, without at the same time risking destabilization of at least some local care home markets. So that's the problem as we see it. So let's go on to the the next slide, please. This is an illustration of the differentials between private pay and public pay. So where does this come from? On the private pay side, we've been, for the last several months now, we've been asking each individual care home in the country, for older people, what their entry point, as it were, is for a single ensuite room privately paid. And the results we get for the averages in different parts of the country are as we display. And as you see, they're all well above what local authorities will pay. And the local authority data comes from the ONS. It's recently published data, which is gathered as part of the Improved Better Care Fund arrangements. So you'll see that broadly private pay fees are way above local authority fees, but it's not even, not by any means. There are quite large variations in individual local authorities, and we're looking here at all 150 local authorities in England. Overall, private pay currently about 40% higher than council paid fees, but differentials vary very widely. So harmonization through 18.3 will bring council fees up and private fees down. The question is, what will the impact be on care home operators? So let's have the next slide, please. So what are the risks? So we have twin policies here of fair price for care, that is elevating the fee rates that local authorities pay, and 18.3, which I guess everyone will know, but I'll state it anyway, that 18.3 is the clause of the Care Act, which is going to be implemented, which will give individuals the right to ask their local authority to arrange care on their behalf, even if they don't qualify for local authority support. So what this means is that in the future, we'll be faced, or care home operators will be faced with people coming through apparently from local authorities who would otherwise be private payers, but the care home operators will have no idea that they are potentially private payers. They'll simply appear as local authority placements. And the issue is, what prices are going to be, what prices the care are going to be arranged at. What the documents are saying at the moment is that the local authority should be aiming to pay at the usual local authority rate. But if the local authority rate is set too low, that's a real problem. So care home operators face a risk that the income loss from 18.3 from private payers, what would otherwise be private payers, will outweigh the income gain from fair price. And if that's the case, then local markets could be destabilized as money drains out. So the lower the cash injection into fair price, the higher the use of 18.3, the greater the risk of destabilization. So what I say is harmonization of fees and an end to endemic cross-subsidization, I think most people would agree is desirable, but only if properly funded. So I think providers will at the very least be looking for a judicious implementation of the reforms. So let's go on to the next slide, please. So how much more will fair price cost? Next one. What we've done here is to track what a local authority fee rate, average fee rates have been across England as a whole, using different sources of information. Those are the green bars, and then above that, the two lines, the brown and the blue, they represent what our care cost benchmarks and models say should be a reasonable average cost of residential care in this case. And you see that the local authority fees diverged from the floor of care cost benchmarks way back, before more than a decade ago, and they diverged quite sharply. They're beginning to track back now, but local authority fee rates are still below what we would regard as being the minimum fair price for care for a very low level or low specification of care home stock. So let's have the next slide, please. So we're fortunate that this is not just us, LaingBuisson, estimating what the cost of establishing a fair price for care would be. We have the evidence from the Competition and Markets Authority in 2017, which said it would cost between 0.9 and 1.1 billion pounds a year to establish a fair cost for care, fair price for care. Now you see in the green box below, in fact I've redacted the numbers that we've estimated, but they are actually consistent with what the CMA estimated, taking into account inflation since. So our figures are roughly equal. And the reason why I'm redacting this is that we've been working with the County Councils Network, who are going to be bringing out an important paper based on work they've done with us, and these figures are contained with that. So we don't want to steal CCN's thunder. But if you look below in the bottom box, you see what the government has earmarked for fair price for care in the first full year, which is 0.38 billion. So it's way below what CMA and we are estimating is a reasonable amount of money to implement the policy of fair price for care. So let's have the next slide, please. So the lower that fair prices are set, the higher the use of 18.3, the greater the risks of income loss for care operators and market destabilization. Let's have the next slide, please. Here again, I've redacted this for the same reason, that we don't want to steal the thunder of County Council Network. If this were not redacted, what it would show is there are certain regions of the country in which, under certain assumptions, the care home sector would actually lose significant amounts of revenue, which is troubling. And that's not a prediction, it's a projection under certain circumstances. But all this says is that, as the government continues with this process, it's really important to be aware of what's happening, and I'm sure that that will happen as the pilots go along, and to be able to make in-flight adjustments as necessary. So let's have the next slide, please. I've left the issues, the problems over social care reforms. We're now looking at a more broader-based market background. So demand. These are, first of all, the historic demand trends, and I've done it by payor group. Now, the first thing to note is that despite the aging population, demand has been stable for the last decade or so, apart from COVID, when it dropped and then it bounced back a little bit. The other thing is that the private pay element of it has been expanding, while the local authority pay side has been slowly diminishing. The NHS has been rising as well. So there's been a trend towards private pay, but that is now set to reverse as a result of the social care reforms, and a reverse through the 18.3, which is described, and also through a so-called pay or shift, which is, the example would be in areas of the country which have fairly low house prices. There'll be a lot of people whose assets are around about the £100,000 mark. They will tip over into public pay. So public pay will increase again. Now private pay will diminish. Next slide, please. Right, this brings it up to the point of why is it that demand has remained constant? Well, perhaps what's happening is that there is substitution between care homes, traditional care homes, and housing with care. What I've done here is to put the graphs of housing with care demand together with care home demand, and that's the yellow line at the top, and you see that that is fairly close to the index of population aging. But within that, care homes, it's the housing with care which is expanding, and care homes remaining fairly constant. So it raises the question of whether the substitution is taking place and will continue to take place in the future. If we go on to the next slide, what we've done is we've assumed just that there will be a continuing substitution effect, and as a consequence, we would project a small increase in demand over the next decade. Not a diminution, but a small increase in demand, but not a big increase in demand as a result of population aging. So that's projections of care home demand. We can go to the next slide, please. Question, will growth be constrained by staffing shortages? Well, we all know what the real problems that all of the care sector providers are having at the moment. This is across the board, from care homes to home care. And if we just put up the next slide, which is simply taken from, it's quite a busy slide, it's taken from Skills for Care. It's just illustrating the number of empty, unfilled jobs at the moment. So we know that there's a real issue at the moment. But what does this say about the future? If we go to the next slide, please. Well, no, before let's go back to the previous one, please. The question is, will staffing shortages constrain supply in the future? Well, frankly, I doubt it, because what the care sector does is to make use of a pool of relatively untrained people, and it's not as if we're dependent, as the NHS is, on pipelines of training people for several years. So I would think that once this crisis is over, and it will be over, that I don't see staffing as being a real constraint on expansion, the relatively small amount of expansion of demand that's required. So let's go on to the next one, and it's underlying profitability. Go on to the next slide, please. And here we have a sort of distinction between those major groups which are public pay focused and those which are private pay focused. And the main thing here is that public pay facing groups are less profitable and trending downwards because of the pressure on fees, whereas the private pay focused ones are either they're certainly higher and stable or even rising. The main one here is Barchester, which is around about 30% EBITDA. I'm not quite sure about the one on the top, which is Avery. That big jump is what their statutory accounts say, but I'm not quite sure whether there's something odd about those statutory accounts that mean I'm misinterpreting it. But anyway, there is a clear difference between the private pay and the public pay operators in terms of profitability. So next slide, please. Quality performance, last slide, just because it's important, we mustn't go without talking about quality performance. Basically, it's the same story as it has been for several years, that local authority operated care homes, a minority, do better in terms of quality, so do not-for-profits. The for-profits are a little bit behind in terms of quality. A little bit lower for nursing, group operators versus non-group group operators. Well, the group operators are slightly better, but basically this has not changed very much in the last 5-10 years. So I think that's come to the end of my presentation. Here's just a bit of a promotional slide. So that's me. Thank you very much for your attention.
William, thank you very much, as ever, for giving us a very clear summary of the economic issues and also the last slide, the quality questions facing the sector. I'm going to ask Jill Quinton first, followed by Bruce Walker, to make a brief contribution based on what William has said. Before I ask Jill to speak, could I just set out the house rules for the rest of this webinar? We've got about 3/4 of an hour of our allocated time left. I emphasize, please, this is a Chatham House discussion, which, and just to be clear what Chatham House means, it means that the content can be discussed, but what can't happen is the content actively reported and attributed outside the discussion. The purpose of this discussion is actually to contribute to the development of the final stages of the publication of this report. So please would ask that we respect the Chatham House principle in this discussion. I shall be asking, when Gillian and Bruce have both spoken, I shall be going to the question and answer process. I think everyone's familiar by now with Q&A on Zoom. I shall also be watching the chat function. So if anybody wants to come in to have to engage in dialogue, this can be a live discussion, doesn't have to be listening to talking heads without the opportunity to contribute. And on that note, it's a great pleasure to welcome Jill Quinton, who's the Corporate Director at Buckinghamshire. She's what I think most of the rest of us would refer to as the Director of Adult Social Services in Buckinghamshire. She has responsibility for all the issues virtually that William was discussing. And Gillian, you're very welcome, and I can't wait to hear how you react to the challenges that William described.
Thank you, Stephen. Yes, a number of challenges ahead of us, and probably one of the most daunting periods that we have to face across the social care system. I just wanted to make a couple of quick comments to really give some examples and evidence to support some of the points actually that William was making. So in Buckinghamshire, we have 65% of our market is self-funding. So a really high level of self-funders. And we have received a market sustainability and fair cost of care grant from the government for the next financial year to help us to prepare for the changes ahead, in particular to do the fair cost of care assessment and the market sustainability assessment. So we received about £1 million to prepare. Now, if the same distribution formula is used in the next year to pay the actual costs of the exercise that we have to do, we will roughly receive about £7 million in Buckinghamshire. We've calculated and used our own formula to assess how much the reforms will actually cost us in Buckinghamshire. Now, our assessment is that if we have a 30% take up of the local authority rates for care from our self-funders, the cost will be £40 million. If we have a 70% take up of the fair cost of care, the local authority rates, the cost will be £70 million. We're receiving 7, and the costs are going to be between 40 and 70 million. Now, those costs include all aspects of the reforms, so it's not just the Section 18(3) changes, but also the care cap costs. So it's all encompassing, but it gives you an idea of the gap that we think exists between the funding and the reality of the costs. So that's the first point. The second point that I'm really worried about is the timescales for implementation of all this. We've got to conduct a fair cost of care exercise along with our providers. and we have to then use that to produce the market sustainability plan. Both of those have to be submitted to government by September this year. Now, the guidance from the Department for Health and Social Care on how to do this isn't due out until March. The toolkit for the fair cost of care is due out in April. It takes at least 3 to 4 months to complete the exercise in consultation with providers. So you can work out the timescale. We're not even going to get the results of that until August, and we need that to produce the market sustainability plan, and both have to be submitted by September. So I'm incredibly worried about the timescales for all this, and have been lobbying very hard for those to be revised by government. So just a couple of examples there to illustrate some of the points that William made.
Yes, I'm sorry. Yes, Gillian. There was one point that occurred to me as you were speaking. There's two huge elements in that reform programme. One is the cap and the other is the fair cost for care. And you were putting the cost of those two changes for Buckinghamshire and putting them together. Is the government committed to doing the two things on the same day? Because in truth, they are two completely separate policies. There's no reason for them to be done at the same moment, I wouldn't have thought.
No, but at the moment, the timescales are similar. It's October 2023 for implementation for both of those. So yeah, the timescales are running concurrently. Yeah,
okay, that's clear. Thank you. So thank you very much, Jill. That's the view from somebody on the front line in the local authority. And then Bruce Walker is on the front line at the operator end, feeling the heat or potentially feeling the heat of the effect of all of this on fees and profitability of your operating companies or your client companies, Bruce. Interested in your view.
Thank you, Stephen. And very interesting to hear on the challenges that Gillian faces alongside others right across the country. Just very quickly, background, Endemic is a pan-European healthcare REIT, only invests in healthcare properties across 8 territories across Europe, headquartered in Brussels, 580 something properties in 8 countries. In the UK, we have just over 100 care homes from the southwest and Chard up all the way up to Inverness in Scotland. So we're very much a national coverage. We have 15 tenants, so we have a broad range of both national and regional players, although I'd say even our sort of smaller regional players have 10 to 15 homes each. So they're sort of smaller groups in many cases. So it's about 7,000 beds. Of that, about 40-something% is local authority funded. We monitor the sources of funding right across our group and all the financial performance. So we deliberately have a what I'd call a sort of blended portfolio of both local authority, a handful of specialists, some NHS, and a fair bit of private pay in our portfolio. So it really is blended. It's not entirely focused on private pay, as some newer investors to the market are. I think just picking up a couple of points in William's presentation, we would sort of certainly echo the feedback that our opcos by and large have fared very robustly financially throughout the COVID crisis. I think that's down to a lot of the support from local authorities. And I would say, if anything, actually, the more local authority focused opcos that we deal with have actually arguably fared better because there has been a fair bit of support. Those that are entirely private pay focused have arguably struggled. They've only had the sort of national handouts, whereas, and I'm sure Gillian's got examples of this, that strategically important local providers, there was a real sense of partnership, I think. And so that was actually a very interesting dynamic to see that pay out. I think the financials, I know William's sort of suggested that things are, have all been fine. We sort of echo that, but there is, we've got to make the point, there is still COVID support coming to opcos at the moment. And when that goes in the coming months, I think you're back to sort of the real challenge at the moment, which is staffing, exacerbated by isolation rules, et cetera, et cetera. general staff shortages across the economy, but it's been an issue even before that, even before COVID. Staffing is a key issue. So I think that's the key challenge going forward. I think fair cost of care, I mean, we can get into the debate. I think as an investor at a broad level, and we're investing heavily, we've got a program of building, we've got 3 on site at the moment, we expect to have another 10 on site new builds this year. Fair cost of care at a broad level is well to be welcome, because hopefully it supports the local authorities in their challenge of meeting the costs, and feeds through to those operators who, you know, frankly, where one's trying to pay sort of less than £100 a day for, you know, the 24/7 and amazing care that is given is difficult. Now, except obviously there's budgetary constraints at the moment. So I think overall that's welcome. I think the difficulty with the aspiration of something like clause 18.3 of saying, well, shouldn't there be a sort of level playing field in terms of the level of fees? That's fine in theory, but as William highlights, actually the subsidy from the private payers and the top-ups has actually meant that's kind of kept a lot of operators going. And I think it would be a shame if 18.3 leads to a polarization of homes where they become either private pay funded or local authority, and you can't have the mixed economy that you have at the moment. Because I think actually that's the only way you get more local authority beds, because at the moment, people like us, you can't make the sums work if you're only working on the sort of £700 a week average fee, as William highlighted. You can't buy the land, build a new home, etc. So the capacity isn't growing for local authority funded homes. It is in the sense of that a lot of the ones that we're involved in are blended. So, you know, you may have an total average fee of £1,000 or more on which the economics work, but an element of that is assumed at the local authority rate. And I think it would be detrimental if that model was undermined by how 18.3 plays out.
Yeah, well, thank you very much, Bruce. It's always seemed to me oversimplifying it, frankly, to think that 18.3 simply means everybody's going to pay the same price, or that there's going to be a coming together of the price for all the reasons you identify. Reinforced, of course, by the point Gillian made about the availability of public funds to pay at higher rates. I was interested, Bruce, and I'm going to ask William to comment on this. If William could come back, turn the screen back on, because you made the point, Bruce, that the economics of care home operators are still being supported by public funding, in particular by exceptional public funding. And Jeff Butcher in the Q&A has, Jeff, are you on the line? Could you make your point rather than me making it for you? Is Jeff able to? Can we bring Jeff in? Yes, we can. It seems you are on a similar point to Bruce.
Hi. Yeah, thank you. Yeah, the point was that I feel that the costs in the care home sector have gone up dramatically in the past 12 months. I think the impact of COVID is still continuing, and I just wonder whether we won't see these come through in 2021-22 annual accounts, and therefore see a much higher rate of failure in the next 12 to 18 months than we did in the previous year. I don't know what William thinks about that, but my sense is we're starting to see a high rate of failure, certainly at the lower end of the market.
Look, it's possible that might happen, and one of the reasons it might happen is that, as you say, the government supporters are going to taper off, and also a lot of businesses will be in a position where they're having to repay loans, civil loans, or bounce back loans, or whatever. Some might be in still be in financial problems when they try to do that. So it's I think this is just something we have to keep a lookout on. And I think one of the things which will tell us or give an indication of what's happening before the accounts come out, because they're always 6 months or more in arrears, is just the level of closures of care homes. As I say, there haven't been any increase in closures yet, but we can monitor that month by month.
Bruce, do you have a comment on that? Do you have a sense that there's an issue on there?
What the profitability after the support?
Absolutely.
Yeah,
the profitability is currently being sustained by exceptional government funding, basically.
Yes, I think so. I think, correct me if I'm wrong, Gillian will probably know more about this, but is in the spring. There's going to be a tapering off of that. So I think you get back to the sort of raw economics of average fees, occupancy, and in particular staff costs, which is the real challenge at the moment. So recruitment retention. I do hope also, and I was heartened, on looking through the detail of the report, the proposed legislation, etc., that there is a commitment to invest in the workforce, because I think if COVID has highlighted, many things, it's the importance of social care and the broader health economy, and the amazing job that carers do, and I think investment in that, and I hope that some of the fair cost of care increase can go towards actually funding better pay for staff, which is the biggest cost by far for all the providers. And to the extent that you can retain more people, of course that cuts agency costs across the whole piece, and to a degree is self-funding. That agency typically costs twice as much. The agency people, of course, don't know the residents, it's disruptive, etc., etc. So if you can drive that out and actually have a more, the best homes that we observe, and our team has close relationships with the home managers, and the best home managers obviously build a very stable team, don't have much agency, all these characteristics are the things we look for in a good home. And if you can help with that, rolling it out across, by investing in the workforce, I think that's the challenge sort of going forward. There's no shortage of capital from people like us to invest in the infrastructure. And just one final point, looking, as William says, there hasn't really been a net increase in beds over the last 10 years. And yet there's been a huge increase, as we know. The good news is we're all living longer. The bad news is there's going to be more people with dementia. So there is definitely the need. So I think it's that balance and how it plays out, really.
Two big questions there. Firstly, the point you were making about staffing and staff shortages, of course, way across the economy, not just in the caring professions in the health and care system. Gillian, I was be interested to know whether you agree with William Laing that this is, and it's less of an issue. I think it'd be fair to say you think, William, it's less of an issue in social care than it is in the NHS, but I'm not sure whether that's a universal view. Let me ask you, Gillian.
The issue of recruitment, you mean, Stephen?
Yes, staffing and staff availability, the ability to have people with the necessary skills.
Yeah, I think it's an issue across the whole sector. At the moment, we're running at 25% vacancies within Buckinghamshire Council for our social care team. So that's a significant depletion of our capacity at a time where we've got significant demand coming in and quite a big backlog that's grown through COVID. So we've got over 1,000 people waiting for social care assessments at the moment, the highest backlog we've ever had, and real struggles to get professionally qualified staff, particularly social workers, occupational therapists. And in the care market, our significant problems are around residential care and domestic care, home care staff, and those have been around for a long time, and if anything I think they're getting worse. So yeah, anything we can do to really look at how we can encourage people into the professions, how we can encourage development of staff and career pathways, how we can enhance the salaries and wages that we can pay to this group of staff. I actually went out and shadowed some of the domestic carers that operate across Buckinghamshire. I was absolutely blown away by the complexity and the difficulty and the challenges, both emotional and physical, of the jobs that they do. And I really couldn't quite believe, what absolute stars they were for the salaries they get. It's absolutely phenomenal, the work that they do. significantly underpaid in my view.
William, do you want to comment on this?
Yeah, I wouldn't want in any way to understate the difficulties that the sector is having and has had in the past. However, what a sector normally does when it's short of staff is it raises its pay rates. The care sector can't do that because it's constrained. It has no flexibility to raise its prices. That's the basic issue. And pay inflation is high at the moment in the rest of the economy. Unfortunately, every pound that's added to a care assistant's pay adds another several £100 million to the national cost of care. The government is going to put £500 million, I believe it is, into staff development, training, etc. But that's not to do with pay rates at all. Now, I know perfectly well that raising pay will not cure all the problems because it's something where you need a vocational commitment, and you don't want to draw in people who are just coming in for the money. But I think the point I'm making is in the long term, that I do not see staff as constraining the sort of expansion of supply that we need in the future, because it's relatively small and because there is a very large pool, if you pay them correctly, of staff. So I take the point you're making, but the long-term view is, well, just what I've said.
The economist always takes the long-term view, so it's
yes, and another economist takes another long-term view.
I want to bring Jane Ashcroft in because I think she's made raised an important issue in the question. Jane, are you able to make your point personally?
Yes, thanks, Stephen, and thanks, William, and others. It's good to join you today. I'm interested in the fact that I think there will be an increasing amount of media comment over the summer about how the reform agenda will really work in practice, and trying to anticipate what that might drive in the way of consumer behaviour. So thinking about families and individuals timing their decisions about looking at care services, when people might anticipate making a move. I would anticipate people might start thinking about the metering system and suggest they don't want to make moves until the metering system starts, for instance. So I think that there is a whole issue of consumer behaviour affected by potential media coverage that we might want to try and factor into our thinking. And I'd welcome panellists' views on whether they think consumers will follow the media narrative on this and what we might anticipate.
Just while the panelists are thinking about the answer to that, it's a very similar point to Dermot Callanan. Dermot, are you able to come in, because you also put a question in about the interrelationship here between the different changes going on and consumer behaviour? Are you able to? Yeah, I think you're coming. No. You've come on the screen and turned the microphone on, but it doesn't seem to be working. So to Jane's question, no, to Jane's question, can I go first to Gillian and then to Bruce?
Yeah, thank you, Stephen, and thank you, Jane, for the question. It'd be interesting, won't it, to see what the media coverage looks like now over the summer, and I'll be watching it with great interest because I do think it could potentially influence behaviours. The first thing that I think it will definitely do is result in a significant surge in demand at the local authority front door for care assessments and financial assessments. So we're expecting a big surge. People will need to undertake a care assessment because it's only activities and needs that are identified in the care assessment that will count towards the care cap. And that in itself is a complexity for us because we're going to have to differentiate between, if people are in a placement at the moment as a self-funder, we're going to then have to look at whether their need determines that they actually need all that service or not. So surging in assessments, that means we're going to need more social workers and more finance people to carry out the work. I think one of the other impacts, interestingly, could be once the care cap is implemented, that people might worry less about going into residential care too early, because they know the care cap will kick in to protect their assets, which I think is a bad thing. You know, I think people should be living as independently as possible for as long as possible. And then I think the other impact of the changes, depending how the media coverage goes, could be quite a significant interest in first party top-ups once the local authority has conducted the care assessment and the financial assessment.
Okay, thank you, Gillian. I understand Dermot is trying to get in, so I'm going to go to Bruce and then try another go to get Dermot in. So could I go to you for next?
Well, I never have any problem getting hold of Dermot normally, but I was speaking to him only yesterday, but he's got plenty to say on the subject. No, to Jane's point, really interesting from one of the main providers and leaders in our sector. So really interesting. I suspect, Jane, you're right, that in the run up to, I think it's October 23, when the clock starts ticking in terms of the cap, that there will be some delays in the run up to that. I suspect. I do think, though, that certainly if you're talking about someone that is developing dementia, it no longer becomes a choice as to when it would be convenient, or when it's right, it becomes a necessity when people can't look after themselves. So I think there will be some delays and some people trying to understand how, once the legislation's actually been fully passed and ironed out, as to how it works and what the impact on them will be. But I do think the media coverage will be quite influential, probably, as to how it's presented. And it's really interesting when there's been attempted reform, as the disastrous Theresa May example shows. What she was proposing actually goes on in a lot of local authorities anyway, of people effectively selling their assets later. It was just appallingly badly presented. So I think it's really important that the presentation is got right, so that there isn't a sort of misinterpretation of the message. But I think it'll be really interesting, and I agree with Gillian that our assumption, and this may be, I don't want to speak for him, but maybe what Dermot was going to get at was that actually you can still pay top-ups under 18.3, which I think is vital that happens, which will still, as I was saying earlier, promote the sort of mixed economy homes, some of which we've built in conjunction with Dermot's company. And that's actually a good thing in terms of expanding the overall number of beds and quality as well, because of course all the newer ones which are replacing the obsolete ones are hopefully more appropriate and better quality.
Okay, thank you. Dermot with hand and not going to be defeated by Zoom.
Hopefully
yeah,
you can
we
hear
can
me.
hear you.
Yeah, good.
Yeah, we can hear you.
And apologies for the technical incompetence earlier. There is a technical point here, which is that choice remains within the framework of the Care Act 2014. And I take a slightly different view, perhaps, to William as to the consequences of 18.3, because from my perspective, and perhaps it's because I'm newer to the sector, I see this move by government as being a substantial improvement. Because what it says to people, and Gillian's picked up on this specifically, is it's no longer a blank check. So if you're going into private pay care, you can sit down with the private pay provider and you can calculate, based upon the local authority rate, based upon the daily living costs and based upon the fees, just how long it's going to take you to reach that cap. If you can take an informed view, and maybe Gillian's concern here about people going into care early is very well founded for this reason, but if you can take an informed view, you can say to a family, look, your worry might be that if you put your loved one into care, you're writing an open check for the future. Actually, we can calculate for you just exactly how much it's going to cost, and you can compare that to the family's resources, equity and property, etc. I actually think the media will struggle to get this right, but if the media do communicate it effectively, this can be seen as a positive to the private pay sector in particular, which ultimately can only help the state sector. I think the two working together is the only way we'll have a successful social care sector. So I think the government have actually been very, very careful in all of their communications to emphasize choice. And I think that by harnessing that choice, this can be, and I use my words carefully, a very effective and very successful subsidy.
So, William.
Look, it could work out that way. I just believe that there are dangers that it won't. And I'm not as sure as perhaps, or not as confident perhaps as you are, that the government knows exactly what it's doing and where it's going to. In the case of the individual presented with the numbers, seeing how much they will have to pay before they become a charge on the state, yeah, that's fine. But then that raises the possibility, and this is a technical point, I agree, that at the end of that period, the particular individual may live for another 5 years with a disparity between what the local authority is willing to pay still and what the fee level is of the private pay care home. So I don't think it's quite as simple as that.
Yeah, that's Gillian, do you want to comment on this? Because that's a familiar dilemma for local authorities, even under the existing arrangements, isn't it?
Yes, it is. And quite frankly, none of us know the answer. We don't. We just have to see how it plays out. And, you know, I think there will be an element of choice available to people as there is at the moment. And I think people will choose to maximize their assets and do what's right for them. So I think that the people that are well informed out there will understand exactly how to use the reforms to maximize the benefit to them. There'll be a whole cohort of people who are not well informed out there who won't know. And that's the dilemma for us. And that's why we don't know whether it's going to be a 40% take up, a 70% take up, or even 100% take up. It really does depend on how people understand the changes and the reforms, and to a great extent, you know, how the media portray them as well.
That's a function of Jane's point, isn't it? The extent to which the media cover these, the implications of these policy changes and how people react to them. Could we go, Phil Murphy has put a question in both the Q&A and the chat, and essentially asking whether the levelling off of residential care places reflects a much talked about shift away from unnecessary residential care into home care and less institution-based care. Phil, are you able to come in? It's looking hopeful.
I sat through the report launch presentation from LaingBuisson, and I was very encouraged to hear that move was taking place, because I think everybody would agree that supported living and home care is a preferred model of care to residential. For those who don't need residential care, there are always going to be the population who do. And it seemed from the presentation that that was a similar trend within older people's residential care. I just wanted confirmation of that, really.
William.
Yes, I mean, it's basically the demand for residential care has plateaued, it's static for older people. And in the case of younger adults, residential care is slowly declining and being replaced by supported living. But both are sort of in the same direction. I mean, if you look at the rates of admission to residential care in different parts of the country, of course, you get the usual thing of huge variability. And then the argument is, well, if it can be done in authority A, why can't it be done in authority B? So I suppose I would argue that there is still potential to reduce the amount of residential care for older people. But then the counter argument to that is simply look at the sort of people that you find in residential care and ask yourself the question, is it really possible that they could be cared for outside?
Candice, you've been, I'm sorry, I haven't come to you, and I should have done, I apologize. Are there points you want to make on either the discussion so far, or in particular around this point of the shift towards home care?
Thanks, Stephen. I think the only thing I would mention, which is in relation to the last comment and also Jeff Butcher's earlier comment, is that we are seeing, working with a number of operators, a focus on quality. And Bruce obviously mentioned, you know, the aims to have 10 new Edifica funded homes on site this year. So the newer, larger homes are preferred, and preferred by families, and also preferred for operational reasons in terms of management and staffing, etc. And at the other end of the operational perspective, we're seeing the smaller operators and the poorer quality homes being transferred out of the care models. And that's okay at the moment because of the focus on housing, which is an equally important government agenda. And many of these older Victorian type homes in remote locations are being converted into supported housing for younger adults, or also housing generally to meet local needs. So I think it is a good time to be transforming the whole care portfolio, and that better matches the care needs of the population as well.
And Jane Ashcroft has come in on the chat on exactly this point as well. Jen, just saying the social care white paper emphasises the value of housing, and the levelling up white paper commits to a task force on older people's housing. As she says, proactive policies in this area would be welcome. Yes, I don't think that, I'm not going to put that to a vote. I don't think it's necessary. I would, however, like to go to Charles Taylor, because I think that's an interesting question. Charles, are you able to unmute yourself?
Yeah, I think I've been unmuted now. So my question was around the introduction of 18.3 that you referred to. That power has been available to local authorities to place on behalf of private payers for a number of years. So why do you think the current reforms will increase the amount of it that's done, done by the local authorities?
I guess go to Gillian. Is this the difference between a power and a duty, or is it simply about profile, or why is this a more pressing problem than it's been for some time?
So the local authority has always had the power and the authority to place people into domestic care at the local authority price, but we've not used our local authority prices for self-funders, and that will be the difference really in the new reforms. So I think it does represent quite a significant shift for us in the way that we operate. So, I mean, the only other powers and abilities that we've had previously have been to provide personal direct payments to people, of course, to organise and manage their own care. So I think it'll be interesting to see how the direct payments market shifts as a result of the new care reforms. I also, Stephen, if you don't mind, just wanted to pick up on the previous question very, very briefly, because I think that was really interesting as well, to look at the levelling off of residential care placements. And I think, you know, they've remained pretty stable during COVID, mainly because of the discharge to assess programme, I think, and local authorities placing people into residential care. But there is an increasing focus nationally and locally now on home first as a philosophy, you know, and I think Jane in the chat bar mentioned all the funding and the focus on housing as a really key determinant of future health and meeting people's needs. And I would absolutely agree with that. I think residential care placements are going to decline in the future, definitely. And I think we'll see an increase in nursing care, dementia care, reduction in residential care, and an increase in housing with care in the community. And that's definitely starting to play out in the southeast of England now.
Thank you. Can I just mention one thing? I was at a meeting yesterday where we were talking in an NHS context about the the NHS programme to develop virtual wards as a way of avoiding unnecessary admissions and speeding discharges. And I wonder whether that's actually has an impact on some of the residential estate as well.
Yeah, quite possibly could have. I mean, I think it's more about admission avoidance than anything else. But once, you know, we're able to use some of the technical support for medical healthcare in people's homes and really digitize some of those programs in people's homes, there's no reason why people can't stay in their own homes for longer. And that's to be welcomed as far as I'm concerned.
William's got his hand up.
Yes, just a bit of context about the question that was raised about the difference between local authorities having a power and having the duty. Just the context is that there are a bit under 200,000 older people supported by councils at the moment in the UK, and about 10,000 of those are so-called full cost payers. So that says the level at which 18.3, as it were, is operating at the moment. So it's there, and I've heard organisations say with great surprise that they found that people, you know, who are being supported by councils in their homes are in fact perfectly capable of paying for themselves. And so it does certainly happen, but at a relatively low level at the moment.
Okay, I want to go to Karen Wilkinson, who's raised, I think, a very. This is the impact that uncertainty around these issues we've been discussing will have, in particular, on new build. I think, Karen, and perhaps that's an issue that it'd be interesting to hear from Candice whether that's been raised by her client base. Karen.
Yes, it was just really that obviously it's quite a crucial point now for certainly us as an organisation, because we've got a new build coming up, and obviously we've got a funder organisation that we're going to be doing a lease back on, and we've obviously budgeted and set our fee rates around, particularly around the self-funder market. And then if fee rates are then harmonised, which has got a potential to reduce our income, I mean, it's a difficult decision to think, you know, is this going to be a viable business, or do we kind of walk away from it now, not knowing what the fee rates are going to actually land at? So, and I think looking at the questions, there's a lot of people that have commented against my question that are obviously in the same situation. So it's really sort of advice or thoughts around that.
Yes, go to Candice, and then this is mainstream Bruce question, I think, probably, but
I think
Candice.
I think it's actually the other way around. I think it's probably Bruce first. I can comment.
Go on then, Bruce first. Yes.
Okay. Well, as I said, we've got quite a pipeline of new builds coming through, and we obviously do a lot of work on the background, the local supply and demand, and what the average fee, etc. One thing we're very careful to do is to not, how can I put this politely, sort of do it purely by spreadsheet and say, well, if you increase the fee to this, then everything else works, etc. It's got to be a sustainable level of rent, you know, over the medium to longer term, because we've seen too many ups and downs in the past. But it is the uncertainty is not helpful, you know, in terms of how these things are going to be funded. But I think we're, as I alluded to earlier, tend to underwrite things on a sort of mixed economy, assuming a certain proportion of private pay, but also, I mean, there are some pure private pay homes that we're funding, but a fair few that are in that sort of blended mix. And I think, in one sense, if local authority fees hopefully go up through the fair cost of care, to William's point, it's really a question of it'll remains to be seen how it'll play out. But in a broader sense, there is more money coming into the market from the state-funded side. So I think Karen's question is very valid. You do have to look very carefully at these things in terms of, you know, what's sustainable over a over a period. I think just one other final part, I think what's really interesting in companies like Dermot's that are probably some of the most prolific developers of homes, is that previously there was only new homes in relatively affluent areas, and these days it seems to be more of a national program. There are opportunities, there are new builds, far more widely based. I think there's a lot of capital chasing it, but I think you do have to evaluate it very, very carefully. I think it's absolutely valid.
So Candice, I was coming to you as wondering if this had been picked up in the sort of potential people bringing new money into the space.
Yes, absolutely. We'd echo that. We've seen investors from the States back now that the pound-dollar ratios are better. We've seen private equity very active in the market. I think there is a question mark as to whether they're the right investors long-term for this type of asset and care needs. But yes, it's an active market, and so just encourage, Karen, that I think all operators are looking very carefully at new builds to get them in the right place, analyse the competition that they'll be working with and against in the area, and look at things like transport and connections to help on the sort of staffing issues that we were discussing earlier.
Okay. Thank you. I've got 4 minutes left according to my timekeeping. So I'm going to ask, I think, each of the panelists to make a brief closing, drawing out the things that are their major takeaways. Can I go to Bruce first, and then to Gillian, and then to Candice and William to wrap it up? So Bruce, please.
Thanks, Stephen. And thank you, LaingBuisson, for hosting this. I think it's really interesting to get the viewpoints on how this may play out. I think the issues we're not quite sure, but as I alluded to just now, I think we see it as broadly positive at a macro level that finally there seems to be an overall attempt at a solution which is looking at not just the cost of care, how it's funded, making it fairer for people. So as Dermot was saying, you can actually budget as a family, and I really welcome the investment in the staff, in the team, and professionalising and upgrading that, because I think they're the people who really make this work. You can have the shiniest home with the best bath taps, etc., but if it's badly run and there's poor care, that doesn't really get you there.
Well, thank you, Bruce. I'm sure we'd also agree with that, and in particular, probably Gillian.
Absolutely, and Stephen, I've really enjoyed today's webinar, and I think there've been some amazing questions, really fantastic challenges and questions, a lot of which we will have to work together on, and that's actually my biggest takeaway, that we need to work together on co-producing the best possible outcomes for our residents and our places. I think the more we can join up provision and commissioning and look at how we can co-produce the right solutions, the better the outcomes will be for all of us.
Okay. Thank you. And it's a big sector, but to do that together. Okay, Candice, including our professional advisors and outside investors.
No, thank you, Stephen, and thank you, Gillian, and Bruce and William, obviously, for all the comments and discussion today. I think, having been in the sector a long time, what never ceases to amaze me is the way it reacts to all sorts of challenges, whether that's financial, whether that's government funding, whether that's healthcare provision or regulatory challenges. And it's a real pleasure as an advisor to work alongside you in these areas. It's obviously going to be a very interesting couple of years ahead.
Yes, that's a Chinese curse, isn't it, to live in interesting times? William, concluding thoughts. You're on mute, William. We almost got there.
Yeah. Okay. Well, look, some of the things we're saying or projecting may seem a bit scary. Remember, they're projections, not predictions. Things can change. I would just say that there are unintended consequences even from the best thought out plans, and I think that the sort of the overarching idea behind the reforms looks good. I just think it's underfunded, and we'd have to take great care.
I challenge, I suspect, any of us to go been to any social care webinar or gathering for the last 9 years that didn't conclude with the thought that it's underfunded. But there's clearly, if there was more money, we could do more. But it's the old challenge, isn't it? With the money that's available, we have to do the best we can. So thank you for joining. I hope that's been an instructive webinar. Thank you in particular to CMS for supporting us in doing this work. Thank you to Bruce and to Gillian and to William for leading us off. And thank you to everyone who's joined us for contributing to what I believe has been a rich and interesting discussion. Thank you, one and all.
Thank you.